just because they choose to rent doesn't make them a lower cost citizen. It's more of a strategy from the young folks. It's always a good time to buy a great deal.
So,
my mentor told me
I
that.
was going to make about a 15% internal rate of return. We drastically outperformed. Hi, I'm Duane Lappinga, Director of Asset Management at TR Wealth Management. I'm here with Bill Mulkey, the owner and president of TR Wealth Management. Bill, thanks for joining us.
Thank you.
For our podcast today, we're going to be talking about achieving 30% plus internal rate of return. That's an annualized rate of return in California multifamily real estate investing. Our format today is going to be a panel, which means that we're going to lean on our producer, Rachel. She's going to ask questions to Bill and I. So, Rachel, thanks for doing that. For today, you're a real estate expert, okay?
that's the part that you don't know, is that I'm not a real estate expert. And I think it's even better that I'm not, because you guys are. So we'll prove that point very shortly.
Thank you. So we're going to cover three main time periods. One is 2000 to about 2006, 2007, which is prior to the Great Recession, and then the actual Great Recession itself, and then coming out of that to the present day. TR Wealth Management has bought, sold, syndicated, and managed properties throughout that period, and we have actually had success throughout that period. The only thing is the parameters and challenges have changed. It's been at times trying, particularly the Great Recession. So we're going to take you through that and show you kind of how we've navigated those three different markets.
And that totally makes sense. And Bill, you understand this too, that you work within the box you're given, right? Okay, so here's the framework. Maybe it's changed, but you don't give up. We work within the box, right? All right. So, Bill, I'm going to start with you. Looking at your track record, which you guys have shown me, which is incredible, you have had so many successful deals, all prior to the Great Recession, during and after. But let's talk about the high returns achieved during the time period before the Great Recession. Tell me about that.
Thank you, Rachel. Thank you very much. I love your voice. It's great. I do. I love it. My real estate investing was really started in 2000, to be honest. I like to tell people it was much earlier because I did some things and I was involved in real estate, which I learned a lot, but it really didn't start crack the beer and start it, until 2000. And that was that first deal that I mentioned that it just made so much money on. And maybe because the first one worked, I was successful. No, I don't think that would have ever stopped me. I had a really big desire to own real estate because so many people that I interviewed, talked to, met with, they own probably at least 30% of their net worth in real estate, and that's not even counting their house. It's a great thing to own. But in 2000 to 2006, the interest rates were higher than they were, I think, at present, and much higher than they were when they ended up settling down. I guess it was a little bit more of an even market. It wasn't just a sellers dominated a market as often as that happens. And we had to find deals that make sense. Sometimes I did deals in what they call B and C areas, not A areas, which implies maybe a little bit more struggle for everybody, but that allowed us to leverage into the property. And to make 30% plus returns, you're going to have to use the bank. You're going to have to use the leverage. If you're not doing a development part, then to achieve very high returns, they're done generally by shorter holding periods from 1 year, 6 months, all the way up to 5 years. Usually not much more than that because they start evening out because our cap rates are going to be lower than that. And, leverage does help with that as well. Leverage can hurt too. So we got to talk about good leverage and bad leverage, but that's probably another time.
So when people talk about interest rates right now, oh, they're out of control, you're like, you have no idea. Like, it's interest rates are interest rates. Do you kind of work around that?
Yeah, for me, I'm kind of like an older expert, but there's people a lot older than I am, and they talk about the 70s and the 80s and how interest rates got really out of hand, and they did. How just investing at 14% or whatever help me, Duane, what's that called? The
prime
inflation,
rate actually,
the prime
at
rate.
one point, it reached 18%, maybe
Oh my
even
God.
20. Yeah, circa 1980. It's incredible.
Yeah, so
That's
that's your credit
crazy.
card. That's your credit card rate. And as you guys can see, Dwayne's very good with the numbers. The CFO kind of guy, asset manager.
Right.
That's why he's good with these things. I might lean on him for make sure that I'm not quoting rates that are wrong. But I was a mortgage broker for a little while. I mean, it's not that I don't know rates, but I just don't have a good grip of the all of the history, because I sometimes drill down to such a low level that I
Hmm.
get a little in the minutia. So you can help kick me along here.
But it's also that you don't let it stop you, right? I've heard over and over again, marry the house, date the rate, right? You're not married to the rate. Marry the house, date the rate, because you can change the rate. When the interest rates change, you can refinance the house, right? Marry the house, date the rate. Have you not heard that?
I've never heard it, but it's perfect.
Isn't that amazing? So don't let it scare you into not investing in the home.
Yeah, when I was talking about loans, when I was selling loans for a short period of time, right out of college, I learned the guy with the gold makes the rules, as I always say, it's true. But I learned that don't worry about that. You're buying the house, you don't buy the rate. You can change the rate and it will change. The
Exactly.
average person holds their loan for about 5 years. It doesn't seem like that, but because you see people that have had the same mortgage for 20, 30, 40 years,
Hmm.
those are usually old mom and pop kettle. But the thing is, everybody else kind of does 5 years or so. And Dwayne and I can talk about how we did it with our personal loans or whatever, but most people change that because their income changes or their life changes or the interest rates change. Yeah, so for 2000, 2006, just getting back to it for a minute,
Yeah.
interest rates were a bit higher. I don't know exact numbers. Generally, cap rates, that means the rate the building will perform at, or cash flow, if you
Hmm.
buy it cash, will perform closer to the interest rate
Hmm.
at that time, but it's not always a direct correlation. It moves together, but it's not always in your favor. So what we did again, though, is we concentrated on buying the BC areas, people that weren't keeping up with properties, people who were more motivated, people who were at the end of their investment period that didn't put a lot of money or time into it. They needed some work. They weren't kept up with modernization, or even just they didn't keep up with pricing. And we were able to buy a lot of those by looking at a lot of deals, kissing a lot of frogs to find the prince. And then we'd buy one and we'd own it from 1 to 5 years typically. Now, during 2006, when things started slowing down
Uh-huh.
because the Great Recession hits, and I got to tell you guys something. By no means was that a Great Recession.
In
It was
2008?
for real estate multifamily.
Okay.
It was bad on housing.
Hmm.
And I know you have something to tell me about
Oh,
your housing.
it was great for me as somebody buying a home. I
Yeah,
mean,
because you shared that with me.
I feel bad for, other people that were losing their asses, but I would never have been able to buy a home if it wasn't for the Great Recession in 2008. There's no way I could have gotten a home.
If you meet me, you can, because again, education, interest rates, I go through all that. So yeah, we can help you at any time. It's always a good time to buy a great deal. My
So
mentor told me that.
I also read that like many of the deals were short holds, like some less than a year. What does that mean? What is
Good.
that?
So sometimes, just to get a little bit sophisticated, not too much, is that if you hold it less than a year, then you can have a short-term capital gain, which is a higher tax rate. So you want to hold it for either 12 months, or conservatively 2 years or more. But there's different ways to do things, because there's different ways to do things. Just ask your accountant.
Okay.
But you can buy something in 1 year and somebody makes you an offer you can't refuse in the next year, and you have two tax calendar years. And as long as you don't just do it repetitively and intentionally, then the IRS leaves you alone. They
Okay.
do. They're not as bad as they sound, but just got to be upfront and honest. And so the shorter period helps the return on your cash flow, because if you return cash flow faster, it's going to help your overall internal rate of return. And that's all the money you put out, all the money you
Your
spend, and all the
pot
money you
is
get back at the end of a period of time. It's very time oriented. I think a lot of investors are very sophisticated, get into that figure, but overall, it's a great judge of looking at an asset, but that target's always moving based on risk, interest rates, and replacement investments, substitutive investments. Everyone says bonds are perfect, they're great, da da da. There's the time period, and now it's now that they're not so great. So it's like The thing about real estate is you can own it, you can affect it, you can affect change, you can delay selling it. So guess what?
Mm-hmm.
Something that I thought I was going to flip in 1 or 2 years, when I hit 2006 and started buying, and when 2008 the Great Recession happened, and again I want to poo-poo it. I hate the Great Recession. You know why? The hard part about the recession was there were single family loans that were going bad. They were going bad because they didn't rate them right. The Big Short's a great movie. Watch that if you just want to get a quick summary or read something about it. But basically, bad loans happened. People were given loans that they couldn't afford, and then they were written off as A loans. It was criminal, absolutely criminal. I mean, if I did anything in my industry like that, I would not be able to be here today and be licensed. I don't know how they get away with it, but they did. I don't trust that. Because when people are calling me and asking me, the big firms are calling me and asking me, you work for a big firm, Bill, what is a cap rate and what do you think a property would sell for? And there was no detail. I'm like, are you going to give this? Yeah, we're going to give this to all of our investors. I'm like, wow, you're calling me about that? Wow, I'm a big company now. I'm like, I just realized that they were kind of printing bull BS,
Mm-hmm.
So I'm like, okay, so now you're an investor, you're going to rely on this third party company to justify that. That's really what happened. There were a lot of bad loans. People could not qualify, and it was greed, just to be honest. So from 2006, when I bought in 2006, I wasn't able to sell in 2007 or 8 for what I wanted. So I'm not perfect. But what
Right.
I was able to do, because I didn't have a house with one person paying, that I wasn't losing my butt on every month, or a really high interest rate that I couldn't afford in the first place, like other people were, I didn't have to give the property back to give the property back to the owner. Plus, I spread my risk over several investors, not just me doing it. So there's
Mm-hmm.
a lot of good things I did right. And if I have 5 or 10 units, paying the rents, even if one didn't pay, I could still pay my bills. And my partners, if I needed a capital call, which I never did, I had never had to the day, in 70 transactions, never had a capital call. Pretty amazing. Southern California, very expensive. All these problems. No, I don't see them. I navigate them, and we navigate them as a company. So I guess my point is the Great Recession did not affect multifamily as much as it did single family. And that's why I'm so glad I'm in multifamily. It just means I spread the risk more than one. But I did have to hold it for longer, and my returns fell a bit. But the thing is, overall, my track record is showing, a 27.5% average. Average. The topic is how do you make over 30? I made over 30 on several properties, a lot of properties, but not every single one.
Okay, but your track record shows you didn't buy any deals in 2009. You had 2 in 2008 and only 1 in 2010. So then what was going on in that time period?
Like most people, if you don't have to buy, you don't, if you don't find the right deal. And we were seeing some headwinds and some choppy water. And so we don't buy 4 or 5 deals a year in choppy water. I think just recently we saw some really big interest rates moving now to today's time. Sorry, I'm
Mm-hmm.
jumping around, but just as an example, people stop buying. And actually, our philosophy, and Duane will help me get into this, is that we feel right now is a great time to buy because people stop buying. So there's not as many buyers. And now it's a good time to buy because people are more motivated to sell and coming to the right price on even a product now, not just B and C, which I was dealing with mostly to get those advantages, to get those leverages. Now I'm buying A properties for better prices because prices have come down a bit. They haven't slumped way, but they've come down to more realistic figures. So that's why, interest rates changed after 2008 to a very low rates. And that's what sparked a lot of the inflation, and hard assets like gold and real estate improve really well. And if they're getting 10 or 12%, let's say spikes in inflation, then, on $1 million property, there's 100 grand. And if I bought $1 million property that was worth $1 million, but I bought it for 900 because I bought it well, and then I put a little bit of money into it and I made another 100 grand, and then I made 100 grand for the market, you can see I made 300 grand. So if
Okay.
I invest $1 million cash and I made $300,000 just on those 3 instruments, those 3 examples, I just made 30% return, so to speak.
Okay, so you mentioned Duane. Let's go forward in the timeline a little bit. Duane, I want
Sure.
to talk about you. You started working with TR Wealth in about 2014, right?
That's right.
What kind of deals were you seeing at that time? So now the Great Recession's over. What was going on?
I actually took a look at some of the deals this morning that we bought during that time period. I won't bore you with too many statistics, but a few of these are kind of eye opening. I came on with Bill for two reasons. I wanted to work with him, but I also wanted to invest my own money in real estate. So I was simultaneously helping him underwrite deals. And I'm looking at these deals as far as, how much money am I going to make? Because I needed to make some money to put my kids through college. I hadn't saved enough. Desperation leads you to do what it takes, I guess. So I was very motivated. And we bought this building in Inglewood for $138 a square foot. The tenants were paying just under $1,000 a month for a 2-bedroom, and the cap rate we entered at was almost 5%. And based on the deals we're seeing today, I can't believe how inexpensive that property was. And yet I remember vividly sitting in Bill's office at that time, and we were disappointed. We were like, this deal is pretty expensive for what it is, and the rate of return is not looking that great. When we put it on paper, it was going to make about a 15% internal rate of return. And I was not blown away by that. I was like, wow, I guess that's all you could do in real estate. And I went ahead and put some money in the deal. And we drastically outperformed our pro forma. Some things broke our way, certainly. There was rent growth. People were placing a lot of money in the market. But I think it just kind of shows that there's always opportunities, and in hindsight you can see how great they were, but when you're looking at the deal in front of you and the headwinds, it's always tough to buy. It's always tough to buy great deals.
But didn't you feel a little bit more confident because you had Bill on your side who knows exactly what he's doing, even though there are always question marks? Did that help your confidence level? And you know what? Okay, yes, there's headwinds. However, I've got somebody who is an expert in this business on my side.
Not on your first deal.
I
It's
was
always scary.
I was kicking the tires a little bit on Bill Mulkey. I was a little hard on him because I was thinking of putting in my hard-earned money. It was kind of all the money that I had at that time, unless I was going to take from my retirement, which that was one thing I wasn't going to touch. But anything other than that was fair game. I did take a lot of confidence from when I asked him questions. He kept going back to 20, 30, 40 deals he had done. And,
Mm-hmm.
on this deal back then, we did this. And one time I did that. And I started to realize, this is not the guy's first rodeo. He's moved rents before, he's managed properties before, he's borrowed money and all that stuff many times. And that put me over the hump, and I invested my money.
So I also saw that like several of your purchases basically were like turned over like a year. So why did you choose to flip the assets basically?
So that's interesting. I was wondering that in hindsight, it's interesting. You don't remember history exactly correct. I was thinking that we just got bored or impatient and turned them over. But I looked at the original pro formas, and we were actually underwriting for about a 2 or 3 year hold on these things. We wanted both of us to grow our capital quickly, and we were buying in Class C areas, buildings that needed a lot of work. So that was the intention going in. And so we were thinking 2 or 3 years. The market went up so fast that we got out after 1 year. I think on that first one in Inglewood, we made almost 50% on it after 1 year. And then Bill pulled out one of his favorite phrases, hey, you never grow broke taking a profit. And I was like, hey, that sounds good to me. And so we did our 1031 exchange and went right into a second property.
So then, Bill, how did this market compare to the previous markets we were discussing?
In a way, it's kind of funny when you put a option on a property to buy, which is basically you put a down payment in, and the seller signs the agreement. I remember the last second the seller asked for a concession, and I wasn't happy about it. It was like 10 grand. I was like, "Mrr." But because I could have used that 10 grand somewhere else, right? But I remember doing it. And I think what's going on with that period of time is basically the market was moving up. We didn't know it, but the undercurrent was pretty good. I think interest rates were very low. So one good thing is when you take out a loan and interest rates are low, is part of your payment goes to the interest, but part of your payment also goes to the principal paying down the loan. So what I saw in these really low interest rate markets is even if we didn't make any money, we were still gaining equity or money in the tenants paying for the for the loan. So we were gaining capital. And I remind people of that because sometimes they think it's all about making money, but sometimes it's about reducing your debt. But the one thing we did do in moving it is that we were able to capitalize on getting more money out and tax defer it into another deal. And I guess not, I hope I'm not stealing his thunder, but what's happening is we went into another deal right over that. And Duane had a way of compounding it and showing me financially how that compounds your money. Yes, there's expenses of sale that people never like to pay, but these returns have already stripped out all of the expenses and there's profit left over. So Duane showed me that we flipped this into another one and then did another one. And we did another one over a period of time, maybe 5 years or more. And we really made more money than what it shows here on the rate of return.
Yeah, let me interject something there. So it actually ended up being a flip, 1031 exchange, and then a 1031 exchange once again. And then we finally cashed out. And when we cashed out, I had made over 100% on my initial investment. And that was in a period of about 3.5 years.
Oh my gosh.
It wildly exceeded my expectations. And the other thing was, at first, I honestly, I was being hard on Bill because I was putting my money in. I hadn't actually done a deal with him. And this Inglewood building it was horrendous to walk through. There was trash everywhere. It was dirty. It was falling apart. The tenants some of them were not great people, no job and causing problems. And I couldn't believe it. TR Wealth Management, they go in there and a really small company, but they cleaned up all that trash, had it all hauled away. There were old cars there that had been sitting there for 10 years, got new tenants, increased the rents. And a lot of the tenants were saying, wow, you guys really cleaned this place up. We like living here. And I was so impressed. I mean, Bill kind of undersold what he could do. And I was really on board from that point. And another thing I was amazed is one of the tenants that was really tough. I go, Bill, how did you get him to leave? And Bill said, I just kindly asked him to leave. And he said, okay.
I think because you were new to it. So when you're walking through a building like that, you're seeing like cha-ching, oh my God, this is costing money. Whereas Bill is seeing, oh my God, this is profit because it doesn't cost that much to clean it up and put some like elbow grease into something, right? To make it livable and appreciate in value.
Yeah.
No,
One
absolutely.
man's trash is another man's treasure. But to be honest, I almost interrupted him and said it really wasn't that bad, Duane. But it's because I've been through it so much. It's really not that intimidating. It's just someone that didn't take care of the property, or someone that's really down on their luck, or somebody who just. A lot of times people think we're being all mean. There's one person in a 2-bedroom, and they don't need a 2-bedroom. They should go to a 1-bedroom. And if I fix it up and the rent's lower, but I decorate the outside of the building and secure it somehow, or make the lawn look nice, all of a sudden, and give them a new refrigerator, new flooring, and it's all clean, they get a second chance to do better too. So we try to revitalize the community. We're also helping buying local products from Home Depot, and that's what makes your stock go up too.
Mm-hmm.
So we're local, and by the way, that's my hometown. So yay for Inglewood! It's done really great.
I just want to say, I also think because you are in building management, property management, you actually talk to people. What do you want to see to make this better? What would make this feel more secure for you? What would make you want to pay more rent, right? Like just raise the rents. It doesn't make people feel happy, right? To pay the rent. But if you are actually asking them, hey, what can we do to help you? I think that helps you guys as a management company as well in the long run, because then you know what people want for your next building.
Yeah,
Yeah.
it was really an eye-opening experience. And you got to keep in mind, my day job, I was doing operation and management of Class A office buildings and walking through those every day. And all of a sudden, I go walk a 6-unit apartment building in Inglewood that's 1960 construction, and nobody's fixed anything in 20 years. It was rather shocking for me. I was like, wow, what am I getting into here?
It can be a little depressing, you guys, but I just love that I mean, you're right. We do talk to people. I mean, here's some of the things that people don't like about investors when they say flip, right?
Mm-hmm.
So I have to be careful that people don't look at me that way. I improve the building. I've gone back and forth in the strategy, so I'd love to hear someone's opinion on what they think. But when I first buy a property, I come there, I meet them with my partner or two, and or my management firm, and we get copies of their keys, or we change the master key to kind of show, okay, it's a different sheriff in town. We're going to really watch things. We're going to make sure things are better. We're willing to spend a little money. So a lot of my projects early on is I came and I started painting the outside of the building, and they're like, oh, these aren't your average people. They're actually going to put money into the property. I did that because flipping, if I flip and you flip and he flips, all they're going to see is increase in rent, right? With no effort. And I don't think that's the way to go. I feel like you got to give something back to these people. You can't just, I've seen some billionaires lose properties because they don't treat their tenants right.
Mm-hmm.
I learned that. Early on in my history. I saw people losing buildings, and I go, why are they doing this? Because they never took care of them. They treated them like trash. Tenants are the wheels you're riding on, man. They're very important. You can't go far in a car if you got a flat tire, right? Or a
Well,
missing wheel.
yeah, you want a long-term tenant that's going to pay you on time. You don't get that by treating them poorly, right?
You'd be
You don't get
surprised.
that.
You'd be surprised because owners, investors feel like they have money, or they have a big business, or they're big, you know, super high earning individual, feel there's like some kind of class differential. And I don't know, just because I've always been from the street, I just, not that I'm Joe Poor Boy, but it's just, look who I am, but where I went and where I grew up, no one would understand that. But I think the thing is, just because they choose to rent doesn't make them a lower cost citizen. And even today, it's more of a strategy from the young folks not to buy a house, not to buy that, to save their money and pay and make money elsewhere. In real
Mm-hmm.
estate, in a side hack, in a business, whatever, all these things you see on the internet, some of these things are great. Okay. A new business, whatever. But in my business, in our business for real estate, if you don't take care of your tenants, they're not going to take care of you. And they're going to walk across the street and rent from someone else for lower, the same, or more because they have a pool and because they got new flooring, and you're out with the Joneses. So modernization, and there's some modernization things you can do to kind of, you know, getting rid of that old refrigerator actually is pretty good because they get something new, but also you save a little bit on utility costs, and there's some good things that are happening in the environment, and you can recycle some of these things too. So not everything is just, churn and burn.
Right.
And when you're talking about that Big Short, everyone gave the investors hell, but you know who bought all those bad homes that people lost? Investors.
Mm-hmm.
And they said they were the whole problem in the first place. No, it wasn't the investors. They just took advantage of the banks that gave them the money. The people that invested that couldn't invest, couldn't afford it, are the ones that had to lose everything. The investors win because they have the money. And sometimes, like
Right.
I said, the guys with the money can take advantage of these situations, and they're not reliant. The people who buy our kind of properties, 4 units, 5 units, 100 units, they have another business income stream. They're not all real estate guys.
Mm-hmm.
So girls, ladies, they have a day job that's paying their bills, and the investment is the investment. And the bank makes you put enough money down and cover each loan. You know, it's almost a little bit foolproof that you can't screw it up. But I see people screwing it up all the time because I'm a professional. But
Mm-hmm.
overall, buying yourself and holding is a great thing. It's just we try to do something a little different than that here.
That brings me to Duane. I'm looking at 2019. You purchased several deals at the beginning of 2019, and you're still holding. Why are you still holding on those deals?
So I did a little bit of research this morning on that as well. And actually, I was pleased to see we had that plan all along on some of these. The original underwriting on this building we bought in Torrance, it was a 9 unit. We bought it in 2019, and we had the intention of holding it for 10 years. And I do vividly remember talking to Bill at that time. He said, I've always wanted to own a building in Torrance. Torrance is where our office is. It's a little bit more of a class B plus, maybe even A minus community, and it's expensive. You pay for that, and we'd always had trouble finding a good buy there. And we found a building that was reasonably priced, barely. I will tell you, we were concerned again, we were overpaying for it, but we went ahead and modeled it with a 10-year hold, and it looked like it would do some cash flow and be a good long-term investment. And we still own it today. The investors are actually making 6% annually on their initial invested capital. And we've also, through refinance, returned about a quarter of what they put in. So it turned out another great deal. It turned out exactly like we wanted. But Bill and I also had some pretty long conversations at that point that, you know, turning over these deals quickly and fixing them up is great, but gosh, it's a ton of work to do that quickly, and you don't get to sit there and enjoy the cash flow. We're going to get old even faster than we are doing business this way. And our investors might actually get tired of it too, because some of them do want cash flow. Sure, if you say, hey, I'll make you a huge profit right now today, they'll take it. But in the long run, you give them consistent cash flow. That's really good for people. And then you save on the transaction costs. So we actually started modeling a lot of properties with longer term hold and started budgeting a little bit higher amount of money. Let's not just fix up the really bad stuff. Let's actually get this building positioned to hold it for the long haul. And I think part of Bill's, aha moment with that was there were some buildings that he never did sell from his early days, and he saw how much money he made on those. So we're kind of migrating to more of a buy and hold company.
So is that why, Bill, I saw that you have assets that you've had for 15, 20 years. Is that kind of why you're holding on to those buildings?
Yeah, that's exactly why. And, it's a pretty difficult task. I feel like a juggler. You got to buy in a market and you got to sell on the same market, because usually the market doesn't change that much in a year's period of time. There's been times, but overall it's kind of pretty mellow. And not lately, but, over decades, a 2% move is not that significant, but it is. So I think what I'm trying to say is that we made good money, and we continue to make good money. It's not broke, don't fix it. The economics are working well. I also learned in that deal, just what I said before, is I'm like, this guy's never going to move out of this 2-bedroom unit. I moved the rent up, but he's never going to leave. And I thought I knew everything. Oh yeah, this guy's never going to leave. And then I gave him a rent increase notice, and he left. I'm like, why'd you leave? He goes, me and my wife don't need a 2-bedroom. We don't need it. We don't need to pay $2,000 plus for a unit. We can pay $1,900 for a 1-bedroom closer to the beach, and we want to move there. I'm like, okay, you're free to do that. So yeah, I don't always have all the answers. I think I know them, and I'm surprised and learn every day. But these properties, holding them, you kind of tend to, I don't want to say this because I'm in charge of them with Dwayne, but I kind of forget about them a little bit because, my uncle said, he was smart. Every investment, a good investment lasts a lifetime. He was very good with that. I learned that. And when one worked, I said, I need more. But he said, every time I go to the property or I'm in town, I spend money on it. Every time I go away from my property, I leave it alone and it does well. So I kind of learned that too, It's not a very sophisticated thing to say, but it works. That doesn't mean it's neglected at all, but it just, you don't always have to be tinkering with it and fixing it, like crazy.
So then what kind of deals do you both prefer?
I'll let you, Dan. I'll let you
Sure.
answer that one because I
Sure.
like all kinds of deals. Deal junkie.
Sure. No, I mean, they can all be exciting, but I would absolutely say buy and hold. Another eye opening thing was we looked back at that Inglewood deal. We actually ended up managing that building for the people we sold it to, and they made a ton of money on it as well. And we looked over the years, and we were like, we made a nice profit, but if we would have held it, we could have made even more. We're we're really migrating towards long-term deals. And as a syndicator, we make money, we share profits with our investors. The more money they make, the more money we make. So actually we have aligned goals. And the really big money is in holding these things for 5, 7, 10 years. And the cash flows you get once you've raised rents, and then the really big gain in value that you profit from upon sale. And going forward, that's really what we want to capture.
So that's what you're recommending to other investors.
Yeah, absolutely. If
Hold
you
for the
want to,
long term.
yeah, if you want to make a really quick money, do development or something. But that's a whole nother risk profile. If you have the stomach for development, I personally don't. I'm a big believer in buy and hold investing.
I think my buy and flip by putting a coat of paint on it, it's faster than development. Development's really slow and very problematic and very risky. There's one person that doesn't vote at a committee to let you build whatever you want to build, and all of a sudden you can't build 40 units, you're going to build 20, and now you're screwed. You bought the land, and that's why they tie you up and do the entitlements first to make sure they can do it. And if they don't do it, then they're taking a huge risk. So you can flip properties, but it's just like I said, you've got to be talented. You can't make too many errors. The market's going to help in your favor. There's a lot of things that have to line up for you, unless you're buying a deep discount because it's in really bad shape, but then you have a construction risk, just depends on who you are and what you feel comfortable with and what you want to do. And we always try to match people in our deals that are partners. Like one guy doesn't want to sell right away and the other guy wants to keep it forever. We want to make sure that everyone's kind of aligned with what our plan is with this property. We make the best plans, but that doesn't mean that at exit year 10 that there's not a real big headwinds and we have to wait till years 11 or 12, or we decide to sell it in year 9 because year 10 doesn't look great. So it's not an absolute hardcore date. It's a feel good date that we're guessing, but who knows what's going to happen in 10 years from now.
But I
We
think,
also,
go
oh,
ahead,
I'm
Duane.
sorry. Yeah, one other point is we started to talk a lot about how we get a great price on selling a deal. The only problem was then we had to go try to find another great deal. And sometimes you're pushed because you have a limited time on the 1031 exchange. You possibly end up being forced into buying not the greatest property in order to avoid the taxes, because you only got a certain number of days to identify that property and then close. So our mentality now is, hey, if we own a great asset that's giving cash flow and performing well, maybe we should keep it rather than throwing away something, because now we've taken the risk out of it. We know the property, we've got great tenants in there, we've done the repairs. You buy a new building, you don't know what you're getting into. You might have nightmare tenants. It might actually need both a new roof and a whole bunch of rotten wood replaced, and you didn't even know it. Every time we buy one of these, you never know what you're going to find until after you close, right, Bill?
Yeah, you can't see through walls. At least not right now. I can't. But one thing I can add to that is just flipping properties is very difficult for all those reasons you just outlined, and it still can be done. But again, things got to line up your way, and it's just better to prepare people for a little bit longer ride than just a short flip. But I love doing any kinds of deals, but I think the biggest insurance I can do is, as a real estate broker, I was really good at evaluating properties. I've evaluated millions for people to sell, to people to buy, right? And I can work both sides of the fence. Isn't that what you're doing when you're flipping? You're a buyer, then you're a seller. So it fit perfect for me. My mom used to restore furniture and she'd buy it wholesale and sell it retail. So I kind of saw her do it. So she was a mentor of mine, right? And it was great. She threw out the junk. She got the good things. She made most of her money on the big items, but she broke even on the middle items, and the other ones went to 1-800-GOT-JUNK, right? That's how she did it. And I watched her, and I was young. I was just helping her carry furniture at the time. So when we buy deals right, we can kind of insulate people from the protection that you're already saving money on the purchase. Your tax rate's lower and your price is lower. So on the other side, I know what willing buyers are willing to pay. So if I know what willing buyers are willing to pay, then I kind of know my upside and my downside, right? So it's a very short period of time if you're in the same market. So you have to buy at a deeper discount in order to make that, like I said before in previous podcasts, maybe that 35% split to pay for all the costs, the in and out costs. So if you're not selling the property for 20 or 30% more, you're probably not going to end up with a profit if you're doing it in the short term.
Okay, so I'm an investor. I want to invest with you guys. You've sold me. How do people get a hold of you guys?
So you can reach us through our website. It's www.trwealthmanagement.com, and you can learn more about our company. There's case studies and our track records there, etc. We would love to hear from you.
All right, and if you guys are subscribed to this podcast, amazing. Comment down below. They will answer your questions, and they may do them in an upcoming episode. So make sure you leave your comments. If you're not subscribed yet, hit the subscribe button. Hit the little bell to be notified. Follow this podcast because it is a wealth of knowledge. Thanks, you guys, for letting me join.
Thank you, Rachel.
It was amazing. Have a great day, everybody.
See you later. Good luck investing.